Welcome. Today we're going to be talking about three things that are probably really close to your heart. One is when and if they're going to lower the interest rates in Canada. The second one is how is what's happening with inflation going to impact the Bank of Canada's decision on those interest rates? And the third part is how, if you're a person who's going to be thinking about buying or selling, when should you be doing that? And also we're going to talk a little bit about what's happening with the Toronto numbers. Hi there, my name is Marcy Verburg. I'm a realtor in Toronto. Okay, so let's get into the discussion. The first thing that we're going to talk about is the interest rates, whether they're going to raise or lower them. Right now, we don't know what they're going to do. Analysts had thought that they're going to be lowering the interest rates in April, but now we've had increased inflation and interest rates are not going to be going down quite as soon. But analyzing these interest rates is kind of like analyzing a stock. There's a whole bunch of economists out there who are looking at a whole bunch of data and trying to figure out what the Bank of Canada is going to do. And of course, the Bank of Canada is being very elusive in what they're telling us. Now, keep in mind that the Bank of Canada has a job. They've been charged with keeping inflation at 2% or lower. And as you know, inflation has been sitting, 3.5% for the last little while. Now, the Bank of Canada is not in charge of housing policy or population policy, whereas the federal government is the one that's in charge of making sure that there's enough homes for everybody. And they need to do that by making sure that their housing and population growth policies are in line. Now, what we're seeing right now, of course, is a little bit of conflict between what's happening with inflation and what's happening with the housing policies. I wanted to go over what makes up the CPI and what is in the basket that we have of goods that we're using to measure inflation. I'm going to show you a chart here. And what you're going to see is that housing or shelter costs, that includes both rent and buying a home, makes up a very large proportion of our basket of goods that we're using to measure inflation. Now, one of the problems is that, of course, every time we raise the interest rates, the housing prices go up in terms of mortgage rates, the rents go up. So what we've seen is a 5.5% increase in inflation over those in the past year. Now, the other thing we've seen, which is kind of really scary and disheartening for a lot of people, is an increase in your actual mortgage cost of 30% versus last year. Now, the last time we saw something like this was in 1982, when there was around a 25% increase in your mortgage cost. So this is actually the highest we've ever seen before. So what the Bank of Canada is trying to think about lowering inflation, those housing costs keep going up, but in many ways, they've been accused of impacting those. They were asked recently by some reporters, why don't you just lower the interest rates and then that should lower inflation and housing costs? But being Bank of Canada, they didn't want to answer that with a straight answer. What they did say, however, is that the only thing they think about is not just real estate like we do. They think about a number of other things in the basket. So a lot of other parts of the basket have been going down. In fact, the majority of other items in the basket have been going down. It's mostly housing costs that have been going up. They said also in the recent report that they're very afraid about food costs going up. Now, the interesting thing about that is I don't know about you. Obviously, I don't want my food costs to go up, but if I had to choose between my mortgage costs going up and my food costs going up, well, I spend a lot less money on food. So I'd rather, honestly, frankly, see my food costs go up 5% than my mortgage costs go up another 30%. But I realize that many people are in different situations and may not even be carrying a mortgage, or they may be seniors. So that may be something that the Bank of Canada is also thinking about. We're talking a little bit about the items that are in the rest of the basket that are not going up as much as housing costs. However, they are staying lower, but altogether we're around 3.5% on average. And economists are now calling this stable inflation. So what they believe is we're kind of, we're hitting kind of a straight line where we're tending to stay within that 3.5%. So now the Bank of Canada needs to make a decision, and that's whether to lower interest rates, even though inflation is remaining above 2%. What the economists are saying, and what TD is saying is most likely to happen, is that they are going to let the interest rates come down even with the 3.5% or 3% inflation. And there's a reason for that, or there's several reasons. One of the main reasons for that is that they can only hold the economy back for so long. By keeping the interest rates high, they are preventing economic growth within this country. So now we need to find a balance between going into recession, not having any economic growth, or keeping the inflation under check. So they are trying to fight with that balance. Now, TD came out with a report recently, and they said that we are already in a situation where the risk is becoming too high with interest rates at this point. So we've got a situation where we're scared about economic growth slowing down. We're worried about interest rates impacting people too much in terms of them losing their home. We're starting to see mortgage defaults starting to occur. So when you put that information together and you start to think about it, well, it kind of signals that it's time at some point this year that they're going to be needing to lower those interest rates, right? Now, of course, none of us has a crystal ball, so we don't know for sure what they're going to do. However, a number of brokers are starting to say, well, that may be more occurring like in a time like June. We have seen the bond yields changing a little bit. And what happens is those affect the fixed rate mortgages, right? However, right now, you can actually get an uninsured fixed rate mortgage for a really good price. So if anybody who has not already had a mortgage or somebody who's kind of new to the market, this could be a good time for you to get in. Now, I'm going to talk just a little bit about what's happening in terms of the Toronto housing because that affects everything. Okay, so in Toronto, what we saw in December was an increase of 3% in the overall cost of a home, and that is across the GTA. We saw single detached homes at about $1.6 million, and they were pretty much flat versus last year. Now, what's really interesting actually is that townhouses went up in price by 25%, but looking into the data, that usually means there's an outlier that's causing something to happen. So that has had an impact, but I don't think all the townhouses went up quite that much. Your semi-detached houses went up about 1.5%, and condos continue to go down slightly in price as more condos flood into the market. That's of course because we've seen the foreign buyer caps in the last couple of years. And just 2 days ago, they also announced that we're going to have a cap on the number of foreign students coming to live in Canada. And as you know, or you may know if you spend a lot of time kind of downtown, foreign students do take up a lot of the housing availability within the downtown core market and in the Toronto area. So that combined together means that the condo prices are, kind of flattening out. So if you're a person looking at buying a condo or upgrading a condo, this could be a really good time for you to get in. We saw also that there was an 11.5% increase in volume in December, and we saw a decrease in the actual number of listings of 6.6% coming onto the market. And so what that means is we're starting to see all this pent-up demand coming back. Now, the Bank of Canada knows there's a lot of pent-up demand for housing because we have this big shortage and a lot of people who want a home. So they're, debating when are we going to let this go? Because they know the minute that they lower those interest rates, this demand is going to come flying back into the market. So if you are a person who is looking to buy a home, you've got a really good window between kind of now and potentially June of this year to buy. And that's, really just an opinion. And that's based on the fact that the housing prices are a little slower right now. We know the housing prices are going to go back up when we see those interest rates change. So what you can do is buy something, get yourself into, a variable rate mortgage, and then lock into something when the interest rates change. Now, of course, I always want you to speak to your bank and your broker about that because I'm not a mortgage broker. I'm kind of repeating what they tell me is the best strategy to do. So make sure you do that. And if you're thinking of upsizing your house, again, it's a good time. If you watch my video about how there's a massive deep freeze in the market kind of late fall of last year, we're starting to see things turn around from there. So have a look at that one where literally nothing was moving. It was like literally, looking like the Wild West with like signs kind of just sitting there ticking back and forth with nothing moving. But now we're seeing things starting to move again. And I think at some point you're going to see them really start to take off. Okay, so there's a little bit of information for you. If you have any questions for me, I'm happy to answer any questions. Please shoot me an email. My information is below. And as always, if you'd love to do a little subscribe or like, that would be great. And other people will see the channel more if you do that. Thanks so much.